I'm meant to go now. We'll lead with the crude oil inventories first. Ten seconds. Draw of 9.285 million, draw of 9.285 million compared to the expected build of 1.766 million. EIA gasoline inventories, a draw of 2.347 million, a draw of 2.347 million compared to the expected build of 0.675 million. Distillate inventories, a build of 4.046 million, build of 4.046 million compared to the expected build of 1.1 million. And crude Cushing inventories, draw of 0.296 million. Mexico's President Sheinbaum says that she will talk USMCA and trade and visas with Canada's PM Carney. According to EIA, US crude exports rise to the highest since December of 2023. We have posted out the weekly EIA crude oil inventory report on the feed for you to read through. And Macklem is speaking at the press briefing for the Bank of Canada. According to EIA, US net imports of crude oil fell in the latest week to the lowest in records, going back to 2001. Bank of Canada considered holding overnight rates steady. The Bank of Canada's Macklem speaking at the press conference. The video is on the feed. Adding that inflation picture hasn't changed much since January. Macklem adds that there are still some mixed signals on inflation. Macklem says we're not being as forward-looking as normal. Macklem says that we have more comfort looking at upward pressure on CPI. Macklem says that we will be assessing the impact of government announcements on targeted support and support for big projects. Macklem says we do need to consider where inflation is going. Inflationary pressures look a little more contained. Macklem says if risks tilt further, we're prepared to take more action. We will take it one meeting at a time. Bank of Canada's Senior Deputy Governor Rogers says we're not contemplating any change in the deposit rate now. Macklem says we're a long way from even contemplating QE. Macklem says that I'm not expecting a recession. Macklem also says that we're not being as forward-looking as normal. Also saying that we're not expecting a recession, we're expecting growth of about 1% in the second half of the year.
a Old Wild West pausa pranzo a partire da 10,50 euro. E il pranzo da casa te lo mangi domani, forse.
Circa una settimana fa qui abbiamo avuto il volume percentuale di 0DT più grande di sempre. Il 69,9% del volume totale dell'S&P era legato alle opzioni 0DT ed è stato molto stabile nelle ultime 2 a 3 settimane, oltre il 60%. Ci sono buone probabilità che questa sarà la scadenza più grande di sempre. Dovrebbe essere...
About a week ago here, We had the largest 0DT percent volume ever. It was 69.9% of total SPX volume was tied to 0DT options. And it's been very stable this last 2-3 weeks, over 60%. There's a pretty good shot that this will be the largest expiration ever. If not, it should be top 3. And the thing when you look at this chart here, obviously there's a lot more calls than puts in this market in terms of value. We're definitely sniffing that, that neighborhood of the most kind of call skewed ever. Interestingly, call prices are actually quite low, which is something we'll mention here in a bit. So the call positions are quite high because there's a lot of value then built up, but people are not like over their skis bullish in terms of options positioning, which is interesting given the all-time highs. We're going into a expiration where vol is really quite tight and really quite suppressed, as I mentioned before. And we're having VIX expiration on the 17th, which lines up with the FOMC obviously on that same day. And so there's a big chance here that we could see, I think, a pretty good move higher in volatility.
So, Brent, I think you are the king of titles here for these presentations, because once again, you've come up with quite a strong one here. Vol Pop Zombie Hunter.
Yeah, I just realized that if you don't have kids, particularly daughters, you have no idea what K-pop demon hunters are. So this may be lost on you, but it is the #1 movie of all time on Netflix, and it's about K-pop stars killing zombies. I guess I've never actually watched it.
What's funny is I do have a daughter who's 11, and I had no idea what this was. There was an episode of Odd Lots, I think, recently where they talked about this, so it must have been like a huge phenomenon. And I brought it up to my daughter. I'm like, "What is this thing?" And she's like, "Dad, how could you possibly not know what K-pop demon hunters is?" So, and then she gave me like all this information that I did not need to know about it, including apparently it was such a quick hit that they can't get the merch out fast enough because like they didn't expect it to be such a hit.
Yeah, you know what? I didn't put this together, but I think those the Zoobies, or what are they called? Those little dolls that everyone's about. Are those also Korean?
Oh, yeah, I know exactly what
you're talking about, right?
Yeah, my kids have them.
I want to say Furb. Anyways, this is the #1 Netflix movie of all time, so it is not that much of like a subgenre thing. And in August, we talked about honey badgers and zombies, and we thought, hey, this is setting up to be a zombie of a market here into August. And well, I can't quite spike the ball and do like a full, Jefferson end zone dance if you're a Vikings guy, but that did seem to kind of play out a little bit. So we're going to talk about that. But the key to this sort of thing is, I thought vol has been set to pop now, and we were talking about the zombie, so it just all sort of meshed together. And so instead of K-pop demon hunters, we're doing the vol pop zombie hunter, and this should say September OPEX. I just realized that.
And it's just crazy. This market is completely crazy. I mean, we had a guy, Doug Clinton from Deepwater, on the podcast like probably 18 months, 2 years ago, and he was talking about this idea that he thought we were probably maybe in like the 3rd inning of a bubble that would exceed the .com bubble because AI was like a more disruptive technology. He's a technology investor, and like me being the value guy, I'm like, yeah, I see that as a possibility, but PE ratios and all that other stuff I like to throw around. And I was like, that's not going to happen. And like it seems like every time we go through one of these, I'm like getting closer and closer to accepting the fact that might be exactly what we're dealing with.
You're starting to talk a lot of macro, and I know people love our macro hot takes.
They do. We get incredible positive comments on our macro takes, as well as our jokes. People love our jokes as well. They're like, bring on more jokes. So we'll keep doing both.
Stay in your lane, boomer, is what I get all the time with this stuff. But yeah, what I see, I'm going to be quite bearish in this presentation, and I only see about 30 days out kind of in time is what my forward view is, generally like kind of OPEX to OPEX, and that's what I'll be talking about here. But this feels extraordinarily toppy to me for a couple of different reasons. But is the idea that they just throw more liquidity at this thing, or they devalue currency more, and everyone just sloshes liquidity on it because we get a 50 bips rate cut, and then we get another 25, so we have 3 by the end of the year, and like just assets just go crazy. Like, I wouldn't say that's impossible, either. And again, that's not a greatest macro hot take, but anything is possible. It feels like in this market, kind of to your point. And so, I'm not trying to load the boat on either side, but certainly in the short term, there's a lot of problems.
Well, my overall point was based on my track record. Obviously, once I come around with this view, it's a. So, I mean, I know you're outside right now. You're not in your normal spot. If you had your 5 screens right now, it would probably be time to hit the one with the puts, because I'm coming around this theme. So this is not in any way an indication of what's going to happen. It's just me kind of seeing what's going on in front of me.
Yeah, and on that point, I am traveling. I'm outside a little bit, so I apologize for that, everybody. And this is September OPEX, even though it says August, so I apologize for that. But with that, we'll jump in. On this point, we never pause on the risk slide, but given our banter here, nothing we say here is investment advice, particularly Jack's advice.
You should probably change the risk slide to reflect particularly anything that comes out of Jack's mouth. Does not count. Yeah, exactly.
Or do the opposite of Jack, the inverse Jack ETF. There's so many, there's more ETFs now than there are single stocks. Were you aware of that?
I saw that. Yeah, I just saw that recently. Yeah. It's pretty insane. I mean, I guess
So
now
Jack-
they're doing all these single stock ETFs and leverage single stock ETFs. I guess that's just going to stay that way now, probably.
Yeah, and I'm not sure exactly how that sign fits in yet, but it feels like some kind of a sign that things are at least that the stock market is sort of just driven by derivatives, and you could put ETFs kind of in that derivatives bucket. And on that point, we talk about this every time, every episode here, that options volumes are growing by leaps and bounds. Stock volumes are growing, but nowhere near the same pace. And so our argument here is that the derivatives, that is the options market, is really impacting the stock market. And some guys like Charlie McGilligan say that options aren't the tail that wags the dog anymore; they're just the dog. And the interesting stat that we have here on this was 9/3, so about a week ago here, we had the largest 0DT percent volume ever. It was 69.9% of total SPX volume was tied to 0DT options. And it's been very stable this last 2-3 weeks, over 60%. And that's part of this zombie thing. And there's going to be a real theme here about crunching short-dated volatility. And I think a lot of 0DT flows are helping to kind of push the market up, keep volatility low. And it's really kind of smushed us to this weird short-term, short-dated vol has gotten very pressed, right? Very low. And I think this is a big function of the dynamic of 0DT options. So as much as a lot of people get sick of hearing about 0DTs, guess what? They keep getting bigger, and I got to keep talking about them.
And on this next slide, when people are making these options transactions, when people are using options more, it leads to flows. And it's probably, I'm probably getting ahead of your presentation like I always do, but I think there's probably not better examples than, I mean, we've seen Open Door recently, we've seen Oracle, we've seen a lot of this stuff going on.
Open Door just traded 3.8 million contracts yesterday, and for a single stock XMAX 7, I had to double check this. I think it's a record. So if you think back to how much volume GME did, whatever, 4 or 5 years ago now, you think about, I can't think of all the different memes that have happened over the day, but take NVIDIA and Tesla out of that equation. I think Open is the highest single stock volume in certainly the last 5 years, maybe ever, for a single day. That's just absolutely bananas, 3.8 million contracts. Even though at the time it was a $6 or $5 stock, now it's a $10 stock. Even though it's such a small cap stock, it's just astonishing volume. And the way that this works is that every time you or me or our friends on Wall Street Bets go and buy calls, the market makers, who trade 90% of what trades on the exchanges, is facilitated by market makers. So they're the ones selling you those calls, Jack. And when they sell calls, they have to buy stock to hedge themselves, right? Because if Open goes from 5 to 10 and they're just sitting there short calls, they're getting hit, right? That is painful. And so the base theory here is they go out and they buy shares of stock. Now in this example, if it's just 100,000 calls and we use a 50 delta, so kind of an at-the-money option typically has about a 50 delta, that can add up to be about 5 million shares of stock. So that's a significant amount of stock. And so this slide is really meant to show everybody what the transmission mechanism is between derivatives and specifically options trading and then the underlying stock.
Yeah, I feel like if I was ever buying calls, they would basically say, like, this is the one time we're not going to hedge it. We'll just go ahead and hold the risk. So if that ever happens, I've never bought a call in my life, but if that does happen, that's probably what they need to do.
We need to have maybe we should have a party one night, one mid-afternoon, and you can buy your first option.
Yeah, I've always wanted to do an iron condor. I don't even know what that is, but I feel like I can't explain it to you, but I just feel like I'd be really cool if I could tell somebody I put on an iron condor.
I never thought about that because it sounds like a really cool trade, but it's like one of the most boring trades because you're just betting that like nothing happens.
At least I can say it does sound very good, yeah, in theory.
Yeah.
So anyway,
Yeah.
I've once again taken you off of your
That's all right. So the big thing here, before Jack rudely interrupted me, was 5 million shares is stock. That's the initial buy to hedge this position, right? But as the stock price changes, you can see here this green line is the delta. The delta changes, so you have to adjust your shares. The delta also changes as implied volatility changes. So if implied vol for the option goes up or down, i.e. the VIX goes up or down as an example, that changes or signifies changes in options value. So hedges have to be adjusted again. And then obviously as time passes, as you can see there on the bottom right, deltas have to be adjusted as well. So these are the effects of gamma, Vanna, and Charm. These are all flows that you'll hear mentioned all the time. And all that simply means is a different way to measure how options flows are changing. which is what we spend so much time on at Spot Gamma.
And Brent and I did a full video on this on the Excess Returns channel. You can find it there. I'll put a link in the description of this as well, where we spent an hour going through exactly Vena Gamma, Charm, how all this works, expirations, like all the stuff that's behind what we talk about in these episodes.
It occurred to me that I haven't asked you, gotten any feedback on that. I just assumed the feedback was incredible, so I just.
It was really good. By the way, like some people like we know behind the scenes, I won't mention their names, but some people we know behind the scenes are like really like sophisticated options guys. Like we've got a couple of people who have reached out and been like, you guys did one of the better jobs I've heard of people of explaining that stuff. So, and it certainly wasn't me explaining anything. So that's kudos to you on that.
That's great. Maybe one day I'll get to meet Ray Dalio. All right. So how this works and why we do this every third Friday of the month, or put it out just before the third Friday of the month, is because options positions build up on that third Friday. Historically, I know I'm going to focus on zero DTs, but it still is the fact that for single stocks and a lot of the S&P positions, they're at the third Friday of every month. And so as we get closer to that date, those positions build up and the hedges associated with those positions build up. And then all of a sudden, as the options expire, those hedges got to get reset. And that can often not only reset the position cycle, so to speak, but it can impact the dynamics in terms of volatility and price direction that we see in the market. Statistically, for example, here you can see that two-thirds of the time, so 66% of the time, we see that the direction of the market will flip around options expiration. So what does this mean? If the market is rallying into OPEX, it will sell off after, or if we're selling into OPEX, we will rally after, right? So that happens about two-thirds of the time, as you can see here. And then the other part of this that is really interesting is the volatility dynamic. Now on this chart, if you see RV, that means realized the volatility of the time, as you can see here. And then the other part of this that is really interesting is the volatility dynamic. Now on this chart, if you see RV, that means realized vol, and delta into means the change in realized vol into expiration, and then delta out is the change in realized vol out of expiration. So in this case, what you see here is when we have low realized vol expirations like we do right now, keep this in your mind, Jack. What tends to happen is 5 days that have of expiration, right? You see that realized vol contract. And then what happens as we get out of expiration? You see that volatility expand, right? That's what that big green bar is showing you. So volatility gets tighter as we get into these areas where bigger positions are, and volatility gets suppressed. And then all of a sudden volatility expands when we reset those positions. This is a low RV, low realized vol expiration, meaning the S&P is not moving around very much, right? The daily vol is quite tight. And here we did an average-based realized vol calculation, realized vol estimate, and you can see there's still this flip, right? It's this volatility flip before and after. So this is interesting to me because we're going into a expiration where vol is really quite tight and really quite suppressed, as I mentioned before. And we're having VIX expiration on the 17th, which lines up with the FOMC, obviously, on that same day. And so, you know, there's a big chance here that we could see, I think, a pretty good move higher in volatility.
And in this next slide, we're getting into gamma and then predicted volatility.
Yeah, so right now this arrow should be a little more to the right. I apologize for everybody here being on the road. My slide deck game is a little off. I should focus less on K-pop Demon Hunters and make my arrow in the right spot. We're a little bit more over here to the right. This has been a very large positive gamma environment, and volatility is really being suppressed because of that. Now, this chart used to be sort of gospel for us that watch the options market. The reason that this chart is changing a little bit, and I'm going to talk about this in a few minutes, is a lot of the gamma positioning now is from zero DT options. And I'm going to show you that in a second, but just also keep that in mind for when I get to one of my big points here. But the bottom line is the more gamma we have, the more positive gamma we have in the S&P, the lower volatility is in the S&P, right? So there's that correlation as we showed in the previous chart. And if we remove positions, then volatility may spike.
So on this next chart, we're looking at all the different events, and many of them were not a big deal for the market. And particularly, I mean, Powell was, Powell was actually more of a big deal to the upside. I mean, I think that surprised a lot, even the macro guys I follow on Twitter, a lot of them were surprised by kind of what Powell said there.
Yeah, and that's always the funny thing is that the macro folks have a tough job, and I don't envy them. But as the old saying goes, it's not the news, it's the reaction to the news that matters. And so a lot of times you can go and say what Powell just said was hawkish, or this CPI number was too hot, or whatever it is, and the market still went up. And a lot of times it's about expectations, right? Was volatility priced too low or too high? what was positioning like into these events. You may have a bad CPI number, Jack, but if you were expecting Armageddon, well, maybe bad is okay, right? So, there's levels to that. And what you can see here is not every single options expiration is this, monumental shift in the way that prices change, but you can see there's absolutely these trigger points which move the market. So in this past February options expiration, I mean, you really can't set that high, intra-market high. This was the all-time high for several months. We just absolutely bled lower. April kind of lows were marked a little bit, by these big expirations. And then more recently, we saw a June low. June was around the time that they had the Iranian peace deal, and we had the JP Morgan collar position that expired right around that at the money level. So there was a lot of options positioning around that kind of geopolitical curveball. And obviously build up here. So August OPEX marked a high. You can see that to the day right there. VIX expiration was a day off the low. So you see these rotations, right? And right now, as of today, we are right here, closed just under 6,600 as we careen into VIX expiration and FOMC on that same day. Now, if positions weren't that large and vol wasn't that low, then we maybe wouldn't make a big deal of this, right? We wouldn't say, hey, like this is something you really need to sit up and pay attention to. In fact, in August, we called this uninterestingly average, right? And so, as we go into this expiration, I think that the volatility complex is flagging a lot of problems, as is the zero DT complex. And so I think that if there is any macro kind of headwind coming out of the Powell FOMC on the 17th, then we could see a pretty nasty correction here.
And then it's interesting too, when you talk about turning points in OPEX, like there's different types of turning points. Obviously there's like the COVID turning point, which is like massive turning point for the market. And like you can see these little moves in the charts. Like sometimes there's a little bit of a reversal at OPEX and it's just short lived and then we move on. So you can have these reversals, but they're not necessarily big reversals every time.
That's 100% right. And I think that if the market, if the VIX is at 50 and we're going to hit an options expiration, then I'm always going to be thinking about, hey, this could be a significant bottom for the market here, right? And the same thing when we're at just these, rip-roaring all-time highs where positioning gets really stretched. I think oftentimes that can be that significant top too. So, if you look at this and you're a macro guy, you're like, well, chart goes bottom left to top right. But if you are a shorter-term swing trader, for example, these are some fairly significant moves around these options expirations, which, I think can, be nice turning points for people with shorter-dated views.
Yeah, and I won't get ahead of you. We'll talk about it later. But you can see this is we are running up into this expiration here, and this is the quarterly expiration. So this is a pretty big expiration we're coming into.
Yeah, and I had this at around $6 trillion if you do the Goldman measurement, which they take every option that has open interest and they assume it's valued at 100 shares of stock. And so that exacerbates or overstates the size of the options complex. But at around 6 trillion, I think there's a pretty good shot that this will be the largest expiration ever. If not, it should be top 3. And the thing when you look at this chart here, what you take away from it is, number one, obviously there's a lot more calls than puts in this market in terms of value. We measure this in terms of delta. So what is the actual call versus put weighting here? And then we don't weight every option that has 100 shares. We use the options delta to determine the equivalent of stock. So this is a much more reasonable calculation in our view. And the point here is that we're very weighted to calls, which makes sense because the market S&P is at all-time highs. And so that's a big deal. The second one is you can see how much is in the S&P complex versus everything else. So I think a lot of times traders will say, hey, why do you focus so much on the S&P 500? There's a lot of other stuff going on. Well, if you look at the size of the options complex, the S&P is bigger than everything else combined. And understand that in the index complex is the S&P, is the NASDAQ, is the Russell positions. So, those two indices, as much as we love our friends at the NASDAQ, it is just a much smaller complex than the S&P at this moment.
And so I think it's a reflection of what we talked about earlier in terms of the options market growing in general. And I think this is like the third one where we've been either had the largest ever or been flirted with the largest ever, like the third straight quarterly, right? So you can see this trend up over time.
100%. March and June of this year, I think March was the largest ever. June was just smaller. Sometimes it goes down to the day, right? We're currently doing this about a week before expiration. So there's a lot of time for position values to change, particularly in this case where we have VIX expiration before, which can kind of loosen positions up, and then we have the Fed, right? So there can be a lot of reactions that can substantially change these values. But as we sit right here, we're looking like we're going to be possibly the largest ever, but one of the top three. And so that infers larger kind of impact to the market.
Is this ultra? I mean, this seems like, when I think about the one we did last time, this seems more call heavy. Is this like ultra call heavy? Because one of the things we learned in terms of reversals is like when you got really strong positioning in one side, that can maybe increase the chances of a reversal. Is that the type of thing we're seeing?
I think that if you look at July was a little bit more skewed, I think, to the call side, but fractionally. So we're definitely sniffing that, that neighborhood of the most kind of call skewed ever. Interestingly, call prices are actually quite low, which is something we'll mention here in a bit. So the call positions are quite high because there's a lot of value then built up, but people are not like over their skis bullish in terms of options positioning, which is interesting given the all-time highs and given what you see here on your screen. And kind of on this point too, just to put some context in, this is the current delta notional, so the stock equivalent value at every expiration between now and obviously, as you can see, a year or so out. And what you see is this is the September expiration, right? It's absolutely giant. And you can compare that to December, which is the end of year, which is always a really large expiration. It just dwarfs everything around it. So, this puts into context how large this expiration is. And again, how impactful it possibly could be.
I don't know if there's data on this, but is there any correlation between the size of the expiration and the potential for a turning point? So like, are bigger expirations more likely to be turning points?
Yeah, I found some evidence for that because of the size of the positions are changing. Now, there's caveats to this because are we weighted to the put side or are we weighted to the call side? Are we looking at price changes versus volatility changes? So, there's a bunch of different dynamics, right, when you're coming to look at this. And what was the price action into the expiration versus after the expiration, right? I think, for example, if you're having a very calm expiration here, and you get a release like this, right, in February, the volatility dynamics are really quite different from pre and post, as is the price movement, right? Whereas in this case, we had tremendous volatility into April options expiration, but April is just a normal monthly expiration, right? So, the size and the movement into the expiration is also a factor. So it presents a bunch of different kind of dynamics that we have to try to measure into these expirations. And so at the end of the day, what I found was the best way to sort of measure this was through looking at realized vol just across all expirations, and then bucketing kind of high and low volatility expirations, and seeing how moves compared.
So to hold ourselves accountable, we always like to take a look back and see what we talked about last time.
Yeah, so our presentation, as I mentioned before, is called Honey Badgers and Zombies. And honey badgers is this joke. There was this old meme that was the honey badger doesn't give a you-know-what, and that's what dip buyers are in this market, right? They don't care. Doesn't matter what the data is. Doesn't matter really about anything. Doesn't even matter about real revenues or fake revenues. We just buy that dip. And that's cool because if we all understand the game, then it's easy to buy the dip along with everybody else. And then the zombie idea was that if and when NVIDIA passed, and NVIDIA earnings passed without much fanfare, and if kind of like all the economic data, monthly economic data, just kind of passed without fanfare, vol was likely to get just crushed, and we would just sort of grind kind of mindlessly higher. And what is interesting about this, and the reason I pause, is because we have some measurements of vol that absolutely got crushed, some which didn't quite get so crushed, right? Different parts of the volatility curve. We're at all-time highs now. We absolutely just kind of like just bled higher over this entire month, right? So those aspects did seem to sort of play out, but it wasn't quite as clean, I think, as what I was thinking back in August. So if we look at this here, this was from August, right? And you can see how low S&P realized vol got. This green line in particular is what I'm looking at. This was at a 6. Right now we're about an 8. I'm going to show this chart again in a few minutes. And 5-day realized vol, this red line. So what's happened last week is really low. It's like 4% right now. So we were at a lower bound of vol in August, and we've kind of revisited that bound. And the idea here is when volatility is getting crushed, when the market's not moving much, that means VIX can come in, implied vol can come in, and this is that kind of Vanna flow that supports the market. I also think when realized vol is going down and implied vol is going down, you see the biggest zero DTE flows come out. Those zero DTE traders seem to be very sensitive to declining implied vol. There's like a correlation there between lower implied vol and lower realized vol and higher zero DTE options.
So, good. We've also talked about this idea of volatility spasms in previous episodes.
Yeah, and the point here was like, the market got a little freaked out this day, Friday, August 1st. And, we posted this joke about how the straddle was priced at, $55. Nobody cared, right? This was looking back and saying, hey, Jackson Hole matters, NVIDIA earnings matter, and if we pass that without much event, then, the market should just keep on grinding higher. I don't think it was a super clean path through those two events, but ultimately it's like, no big deal. We're going to get rate cuts and kind of up we go. So, that was a big part of this. Here we were looking at correlation in VIX, and the idea was, VIX should come down a lot, or could come down a lot here into September. VIX is at 14. I thought it would maybe be a little bit lower. The other one we're going to talk about here is Core 1M, right? That's the correlation metric that shows us kind of levels of bullishness and bearishness in the market. That stayed a little bit higher as well. We're going to talk about that. So again, we got kind of the partial zombie. We got the price action, I think, of the zombie. But looking back in August, maybe it wasn't kind of full zombie.
Just on that slide before, the Jackson Hole and NVIDIA slide, how much were options traders worried about Jackson Hole? I mean, we know obviously it was bullish and the market ended up going up a lot, but going into it, is there a lot of concern with that or no?
Yeah, I think that the vols were elevated there, but they weren't that high, really, right? The NVIDIA earnings are pricing in 5% implied move. In Jackson Hole, I don't even think it was pricing in a percent, right? So there was relative concern because you could see that bump in the term structure, right, when we got into that event. But there wasn't a whole lot of excessive. There's been times where we've seen 3% implied moves for like a CPI or something, and this just wasn't that wasn't that event. And if we look at the implied volatility tied to this upcoming FOMC, it's the same thing. It's like people just don't believe that there can be a significant risk-off moment.
Yeah, I guess part of that, at least coming to the current FOMC, is the Fed is fairly telegraphed what they're going to do these days. There's not usually a shocking move. I remember back earlier in my career, there were like the shocking moves out of the Fed. Like that doesn't happen too much anymore.
Yeah, and I think that they don't want to invoke market volatility, I think, as a general rule of thumb. Like it wouldn't look good if they stepped up there and just triggered a 2, 3, 4% market decline every time they spoke. So I do think your point is well taken there. And then this idea around what the zombie needed was rate cuts. Well, not only are we, seems like in all likelihood, definitely getting 25 bips, we may even get 50 now. Those odds seem to be increasing. So, that makes equity markets, at least currently, happy. And our target to the upside was 6,500. And what we said was, look, if there is a market decline at all, right, the honey badger was there because of this positive gamma below. And this is an important dynamic because this was the view in August. And these bars that are positive here imply positive gamma, which means that as the market comes down, market makers and dealers may be buying that dip, right? What it says is traders were selling puts into that event. That's why the honey badger is so excited about price coming down there, because they'll buy up that dip. And then to the upside, we were flagging 6,500 as this big level. That 6,500 is still critical here because we had the JP Morgan collar trade is struck at 6,505, and that expires at the end of the month. So when we go forward here, we're going to talk more about 6,500, but we definitely obviously achieved that 6,500, and we actually moved a little bit higher today. I think we just tagged at 6,600. We may have been just shy of it by 1 or 2 handles today, but we definitely kind of moved up through this, and the zombies kind of kept on marching through that strike. And then the last thing here is look at these dots, right? Because I'm going to show you an updated slide of this. You can see a lot of this rate sensitive stuff was starting to move to the right vis-a-vis the housing index, for example. A lot of these tech names and stuff, different sectors were suddenly starting to kind of creep to the right? And so there was some mild bullishness positioning, or they're starting to pick up bullish positioning in August. And if you remember this chart, we're going to show you an update of this, which shows you that all of these positions now are all the way to the left. So whatever mild bullish positions were kind of in August, they are gone here as we head into September, which is interesting given equities are at all-time highs.
For people who are familiar with it, could you just explain what the 4 quadrants here mean?
Yeah, so the way that we look at this is IV rank. So IV rank, if it has high implied volatility, right? If traders are pricing in a lot of volatility for the stock or sector we're looking at, it will show to the top of this chart. And then obviously it's to the bottom, the implied volatility or the forward sort of look at volatility is lower. Now this incorporates the last year. So the huge August crashes, for example, are going to be compared against some of these names or against these time frames, right? So if you're looking at carrier spiders, we're pretty low implied volatility rank. People aren't expecting much in terms of a lot of movement going forward. Now, if people are really bulled up and buying tons of calls, and really calls have very high values, they will show up towards the right, right? So gold, which is still hot, was hot in August. People are bidding up those calls. That means the dot shows up to the right. And if they're very put heavy, if traders are really buying puts, hedging the downside, then the dot will show up more towards the left. So that's a relative measure of calls and puts across the x-axis.
So as we get into September here, we're gonna look at the same chart, right? And now we're gonna. What's interesting to me, and I guess it's the same thing from last time, is you're not really seeing that aggressive call buying like in tech and stuff that I would expect to see, given what's going on in the market.
Yeah, and that to me is a little bit of a conundrum, and there's several conundrums here, I will say. And what I kind of read is happening is that we're not so much seeing people really piling into puts at the moment as much as cooling off on the idea of wanting calls. And we're also seeing these like rolling spasms of names which are breaking out, and then those names are really consolidating quite a bit, right? So it's a little bit of a unclear situation as to what traders are pricing in or what they're expecting. In other words, if there's a name to chase, they go and chase that name right now, but it doesn't seem to be a situation where people are going, okay, like Oracle, for example, which is up 40%, has just sort of signaled a new age of AI, right? We're at 40%. There was a ton of derivative trading that day, big options volume, a lot of momentum trading, and then that move sort of faded quite violently, right? And it turns out like they're giving revenue to NVIDIA and NVIDIA's giving revenue back, right? It's like this weird cycle. It's not like, hey, we just opened a new chip and, you know, like more growth for America and let this sector get bid. So I think there's a loss of leadership in a way right now. And then the other side is as rates change, it may make more different asset classes attractive, right? So do I want to go trade in bonds now or some other asset because we think rates are about to change and change quite significantly? So maybe that's the better trade. And so people will shift a little bit out of equities.
I didn't follow the Oracle thing. Did Oracle come way back down after that day?
Oracle was up. Yeah, Oracle was up. They touched 340, 350 on Thursday, and they traded down to about 290 today. So it was a pretty good reversal. Stock obviously still up from earnings, but you know that's a really big reversal from those really exuberant gains. And again, I think this is a lot of the derivative complex, like pumping things up, leveraged ETFs, momentum trading, right? People chasing. And so much kind of day trading activity these days that moves just get expanded very quickly.
Bye.